Borrowing from your 401k might feel safe, but paying back after tax dollars and then being taxed again in retirement leads to double taxation. If you leave your job and can't repay the loan within 60 to 90 days, it's treated as an early withdrawal, subject to income tax and a 10% penalty. So imagine you borrow $20,000 for home renovations and then out of nowhere you lose your job. Suddenly, you're not just dealing with the stress of unemployment, you're also hit with taxes and penalties, and your future wealth has just been shrunk. Probably a lot more than you expected. Standard withdrawals before age 59 and a half, well, they're just as damaging. First, you've got to pay ordinary income tax, and in many cases, you'll probably get pushed into a higher tax bracket. Then, to add insult to injury, the IRS slaps on a 10% penalty. It really adds up quickly. But honestly, the deadliest cost is lost compound growth. So let's say you take a $15,000 withdrawal at age 40. After taxes and penalty, you might only end up with about $10,500. If you'd left that money alone and let it grow at a 7% annual return, it could have turned into nearly $80,000 by age 65. So early withdrawals don't just cost you now, they actually rob you of decades of growth. Job changes bring hidden dangers too. Without careful planning, people often cash out old 401ks by mistake, incurring taxes and penalties again. Even worse, transfer or administrative fees, though small individually, can add up over multiple jobs. And some small, forgotten accounts continue to bleed away in fees. The smart move always initiate a direct rollover into a new employer's 401k or an IRA. On the positive side, the Secure 2.0 Act brings powerful enhancements beginning in 2025. Individuals aged 60 through 63 can now make super catch-up contributions of up to $11,250, a significant boost above the prior $7,500 catch-up limit. New retirement plans must automatically enroll employees with an opt-out allowed starting at 3 to 10% deferral rate with an annual escalation to 10 to 15%. Part-time employees will qualify sooner after just 2 consecutive years of 500 plus hours worked. Contribution limits also increased in 2025. Those under 50 can put away $23,500, while age 50 plus savers can still use the $7,500 catch-up, and those 60 to 63 enjoy the $11,250 super boost. Secure 2.0 also phases in Roth-only catch-ups for high earners over $145,000 starting in 2026. And by 2033, required minimum distributions won't begin until age 75, up from 73 today. Meanwhile, Social Security is also shifting. Starting in 2026, the full retirement age will rise to 67 for anyone born in 1960 or later, yours truly, meaning you'll need to work longer to claim full benefits. The cost of living adjustment for 2026 is projected at 2.7%, which is about $54 more per month than the average for the average retiree. But, higher Medicare premiums will likely eat into much of that increase. The Social Security wage cap will climb to $183,600, raising payroll tax obligations for high earners. Even more concerning, the trust fund faces possible insolvency by 2033, which could mean benefits cuts up to 23% without congressional intervention. Tax rules around Social Security add another layer of complexity. Because the income threshold for taxing benefits haven't been adjusted for inflation in decades, more retirees will pay taxes on their Social Security each year. This bracket creep means even modest income or COLA increases can push benefits into taxable territory, costing retirees thousands. All of this underscores a critical truth. Your 401k and Social Security are under pressure from both personal mistakes and shifting policy. But you can fight back. Build an emergency fund so you don't tap retirement early. Take advantage of Secure 2.0's new features like catch-up contributions, auto-enrollment, and delayed required minimum distributions, and plan strategically for Social Security, recognizing that benefits may be taxed more heavily and could face cuts in the future. In the end, every decision today Whether to withdraw, roll over, invest, or defer affects decades of your retirement potential. Don't let short-term thinking steal your future. Protect your savings, maximize new opportunities, and prepare for Social Security's evolving landscape. Thank you for watching, and this has been Less is the New Retired.